we're flashing up and down 89, 88, 85. It's moving. Markets aren't focusing on the same things anymore. That's what's going to drive markets. That's what creates interest. So, question then comes down to, why does a strategy stop working, or why do trades stop working? A lot of this comes down to environment. I've highlighted the idea of environment a lot because this really is what's shifting for most people. People have strategies for all sorts of different environments. Now, as time goes by, environments start to change. Trades that worked here do not work here in the same way. So what you need to then try and work out is, how is the environment changing? What is going on? And this all comes down to tracking consistent metrics and being consistent in that, day after day in your debrief. How are these metrics changing? That is what enables you to define a change in environment and recognize now new strategies that might need to be employed in order to be able to achieve what you want to achieve. So let's go and have a little look. 3 key ways that environments change, or 3 key ways you can identify a change in environment. Volatility. This isn't looking at the VIX and changing your mind on volatility day in, day out. This is understanding the way the market is moving on a day-to-day basis. You're trading it. You're experiencing it. You don't need to wait for the VIX to tell you that volatility is high or low. You know, you can sense it. What this does impact, though, is your expectations of size of movement, because with volatility generally comes an increase in range, and also the frequency of trades that you can take on. High volatility environments, you may get what is typically a month's worth of trade in a week. So you get more opportunities to trade. Doesn't mean there's better trades. There's just more chances. There's more shots that you can take. The other thing to watch out for is correlation. Now, again, this is looking at how things are correlating now, and then how they are correlating next week, next month. Are things still moving in the same way? What narrative tracking is all about is you're trying to understand how sensitive markets are to something. So I'll come and explain that in a little bit. But as a narrative becomes more clear, sensitivity goes up. This makes more trading opportunities. With less narrative, less theme in a market, there's less sensitivity. So there's other things that can happen. There's multiple different scenarios, things that can go on that can move the market. But this doesn't mean there's then one overarching thing and one clear driver. So volatility. I said you don't need VIX. This in the middle is VIX. You don't need it. It's a real simple thing to see volatility. If you watch that ladder on the left, this is, and I've used 2 examples, S&P 30 seconds or 30 seconds to a minute after the CPI data release. So same data, but looking at this from last year and looking at this then from 2019. So 3 years prior, when volatility wasn't as high. You watch what happens in 2019. So just watch the ladder and the way it moves. Remember, this is about a minute after the data. Reasonably steady. It's a relatively thick looking ladder. There's not loads going on. It's not shooting up and down, whizzing all over the place. It's quite steady. We've moved from around about 2 down to 1 in the S&P, maybe 3. That was it. That's 15 seconds, a minute after the data. You look now at the right-hand ladder and you see how much quicker that's moving. Traded 91, we traded 87 already. We're flashing up and down 89, 88, 85. It's moving. It's moving a lot more. It's moving so much faster. It's got less liquidity. We're trading 96 now. So you've just seen that again, 15 seconds, that's moved 10 handles. So correlation then. The way I'm looking at correlation is very simple. I'm not one for looking at, again, correlation charts and trying to look at, variance in that. What I'm looking at is get 2 charts, same time period, short time frame, because correlation from a day trader's perspective is about, does this one market help influence the other market right now? Can you trade off it? So you take a look here. This is a 1-minute chart of 5-year treasuries and the S&P. What you've got, and this one is from last year, November, very, very obvious relative correlation between the two. They both run higher. They then sit sideways. They both drop, pull back, drop, pull back, drop. Same again. Drop, pull back, drop, pull back, drop. It's almost identical. Yes, they're not absolutely perfect, but they do the same moves at the same time. These two markets during 2022 worked astoundingly well together, simply because they're both reacting off the same metric, the idea that the Fed will or won't cut interest rates. So that was 2022. That was the back end of 2022. What you get now is a shift. Similar data point, so similar period of time. You look at the 5-year rallies, pull back, goes again. S&P rallies, reverses, goes down. Completely different situation. So what you're getting here is a situation where that correlation has died off. Soon as you see that, again, this is now saying to you, situation's changing. Markets aren't focusing on the same things anymore. So therefore, you now need to drop that correlation. That can be a strategy in itself. You drop that and you start to look at markets a little bit more independently. I don't believe that the situation is always different. The situation is the same until it changes. That's the point of taking a loss. You assume the same thing until it changes. That way, you're maximizing the situation. Markets react in a certain way and they correlate in a certain way. They'll continue to do so until there's a reason for them to not. So you assume the same until it changes. The loss is what tells you something's changing. The other thing regarding environment change is narrative, a narrative shift. Now, what we're seeing at the moment is more predictability. I got asked about this earlier, and somebody said, oh yeah, but there's uncertainty regarding this and this and this. Now, you can have uncertainty regarding multiple different things, but that's what's going to drive markets. That's what creates interest. When people talk about the possibility of recession, of banking crises, of all sorts of other things, these are possibilities. That's not uncertainty, because we're not heading towards one and we're not sure how we're going to get there. What we're doing is we're listing things that could happen. There's a possibility aliens might land. There's a possibility we could come up with all sorts of new innovations. Any of these things are possible. That doesn't mean it's uncertain. From a trading perspective, uncertainty comes where there is a clear theme in the market, and it's now uncertain about how that resolves itself. It seems much more clear now from inflation how that resolves itself. So therefore, the uncertainty is falling, predictability comes in, that changes the environment as well.